Hey guys, Fabio here. Hope you all had a great week and are all ready for the weekend. In today's episode, I'm going to be explaining why 90% of the day traders lose 90% of their money in the first 90 days of trading. So if you want to learn how to become a profitable Forex trader, make sure to watch this video, join the link to my Discord server in the description down below, and leave a like and subscribe. So enjoy, guys. Okay guys, so first of all, what I want to do with you guys is explain how a retail trader trades the Forex market. So essentially there are two kind of strategies which are mainly used under retail traders once they just start out trading. So first of all, we have the breakout strategy. And what does the breakout strategy essentially mean? Well, it means that you have to identify support and resistance. So what you then do once support and resistance is identified is you wait for the breakout out of the area of consolidation or out of resistance or out of support, and you essentially just trade the first candle which closes outside support and resistance. So an example just to showcase this is what people do is that they have then this area of support within the market over here. They see a bullish close above this area of support and resistance, and they then take a buy to the next area of resistance up above over here with their stop loss underneath the low of the candle. So that's method one, which retail traders were likely to use. So this is more the beginner version, and the second and more advanced version would have to be just the easy Fibonacci setup. So what people do is they identify a trend, and what they then do is they draw on their Fibonacci, and they start looking for candlestick patterns at, for instance, the 618 Fibonacci. So let's say a star pattern or an engulfing candle at the 618 Fib to then sell the market back down in towards the lows. However, there is one problem with this method in my opinion, and let me show you why. So looking at the current market structure over here, what you can for instance say is that we have a Fib setup over here. So we draw in the Fib from the swing high over here all the way down to the swing low. Then what we can see is that we see rejection at the 618 Fib, right? So we see, for instance, this star pattern over here, or let me put it this way, this engulfing candle over here, put their stop loss above the high, get stopped out. Another setup people could take is this tweezer top over here with some upside rejection on the wicks, take the trade back down in towards lows. However, market goes into your favor or into your direction, but then boom, comes back for your stop loss. So why are you still losing trades, you may ask? Well, first of all, the first thing that you have to start deleting from your trading plan is support and resistance. Why? Well, support and resistance, first of all, is very subjective. Everybody can draw it in their own way, and you as a trader can't draw in those support and resistance levels the same each time that you look at the markets. And when trading, you want to become a robot. You want to do the exact same thing over and over again, because when you backtest your strategy in, let's say, and you put your data into, let's say, Excel, what you want to do is you want to look at the data generated. However, this data must always be objective obtained data through a mechanical or a strategy which is as mechanical as possible. Why? Well, when trading the live markets, what will happen is that if you have a very subjective strategy, so a strategy which changes all the time with random support and resistance levels, you will never really be able to replicate the backtested strategy of which you put all the data into, let's say, Excel. So then you may ask, well, how can I then become a profitable Forex trader? Well, the first thing that I want you guys to use is supply and demand. So supply and demand, I made a quick video on this on my channel, so make sure to check that out. So that is the first thing I want you guys to just start identifying, because that will massively benefit your trading. Second of all is, of course, Fibonacci alongside the price patterns. So why do we need to use price patterns? Well, price patterns help you identify these kind of stop hunts which retail traders get screwed by. So an example of a stop hunt on price patterns, or how you can identify a stop hunt on price patterns, is for instance this ascending channel. So where a lot of traders would go short at resistance over here, because of course we had support, then we had resistance, then we had some bearish candles over here. So people start looking for sells in towards the downside. We can see that the market still starts moving up in towards the highs once again. So why is this, you may ask? Well, this mainly has to do with the fact that the first time people short the market, when market comes back to resistance, is that they place their stop loss above the high. So this is the first stop loss placement, just above resistance. So what can we see? Well, the market comes back up, takes out the stop losses, then starts moving back down again. Okay, well, people once again go short over here because remember this was that 618 Fibonacci setup. So people then once again place their stop loss above the high, market goes down, market comes back up again, takes out the stop losses situated above the high once again, and then they go short. However, one more position that traders could have had and where the stop loss could have been is of course above the swing high of where the Fibonacci was initiated. So that is over here. And as you can see, the market comes exactly to take out those stop losses situated above the high and then starts moving down. So that is why a price pattern can be the perfect combat method to combat those kind of stop loss hunts which retail traders get screwed over by. So what you always want to do is write down the 1, 2, 3 method and always look for a short at the third touch of the ascending trend line. Of course, when it's an ascending wedge. So when it's an ascending wedge, you want to look for a 1, 2, 3. When it's a descending wedge or channel, you want to look for the 1, 2, 3 with the third touch being down below, of course. But for more information on that, make sure to check out the video on price patterns on my channel. But yeah, this 1, 2, 3 method will really benefit you when trading. Also looking, of course, for a fake out on the highs as happened over here. Can really benefit your trading because above the swing high, of course, stop losses are placed and breakout traders will be looking to take a long position because once again, this is of course an area of resistance within the market. The market is making higher highs and higher lows. So the market is trending upwards as most retail traders would think. So they think, okay, well, now we're going to start moving up before then once again creating a new higher low, right? However, if we know how the market moves, you know that this is just the correction in the form of an ascending channel before we are going to be heading down next. So yeah, that is essentially how you can change your trading plan, how you can adjust your trading plan to become a profitable Forex trader, and you can outplay all the people who still use retail trading methods. So I hope you guys enjoyed this video. If you have any questions whatsoever, make sure to contact me through Discord. I hope you all have a great weekend and let's speak soon. Thanks for watching, guys.